Hello and welcome to Weekend Investing Daily Bytes. We are back after a few weeks to shoot episode 148. Today is 20th of December, and we had a major fall in the market. The market had been correcting since the last few weeks, but today's fall seemed, extremely concentrated in terms of each sector, and there just was no room for any you know any escaping the fall today. So if you look at the markets, uh, each and every sector was down in the red. Of course, the sectors which are defensive, usually the pharma, FMCG, IT, they were less hit, but could not escape the fall in any case. And the more risk on sort of sectors, real estate, metals, PSU banks, they really had a bad tumble. Almost 5% down on real estate index, almost 4.48% down on PSU banks. So quite a dramatic down day, despite a 200-point bounce at the end. Nifty still managed to fall 2.18%, uh, and Bank Nifty at minus 3.3%. So pretty rough day for all investors. Some traders, of course, made a lot of money today. Those who were positioned on the short side in our stairs product, we were positioned short since the last week. So some relief there on that front. In terms of the weekend investing strategies, again in line with the market, small caps and mid caps getting hit much harder than the large caps today. About 3.5% down on mid and small cap 400 index, about 3.5% down on small cap 250 index also. And in line with the market trends, all our strategies took a beating, with MI20 getting hit the worst at minus 4.39%, and LTCNX 200 and MI30 being in the 2% roughly range. So all in all, bad day, but bad days keep coming, and that is the intent of today's daily bite, is to showcase in the last about 2 decades what is the kind of falls that we have seen, how the market has recovered from them, what is the extent, frequency of these falls. So just to give some perspective to new users also, that how has the market behaved in the past, and what we are seeing now is maybe really nothing new as such. This keeps happening from time to time, and this is the nature of the market. The nature of the market is to build excesses, and then those excesses get written off, and then the pendulum swings to the other side, to the other extreme, where the markets may become under-owned, uh, stocks become under-owned, and then the cycle starts again. So it keeps rocking between over ownership, under ownership, overvaluation, undervaluation, and that's how the nature of the market is. So in the morning I tweeted about Nifty being just 2.5% away from 200 DMA. So 200 DMA is a very watched sort of a level. It's basically the moving average of the last 200 days. If it's a 200 WMA, it's 200 weeks moving average. What that does is gives you a sense of where is the averages for the last 1 year. And usually when the market comes back after having been away from the 200 DMA, it is considered to have lost most of the froth. And of course it can still go much lower. It's not to say that if you have reached 200 DMA from the top, then market will stop going up, but more realistic levels are near about 200 DMA. And of course, as the more you go below it, the more is the sort of value that you can derive out of that. So let's take a look at some charts first. Let me just take you to some charts. So this chart is showing you the movement of Nifty over the last 2 decades from approximately 2000 2001 till to 2021. So as we can see in this particular rally that we saw from 2003 to 2008, the Nifty came back to its 200-day moving average many times. 1, 2, 3, 4, 5, 6, and seventh time the rally broke down. The GFC fall came. So you can see that coming back to 200 DMA was frequent almost every year, and then of course the large crack that happened. And then again in this rally you can see it went up, then came back to the 200 DMA, went up, came back, and then there was some correction here. So all through you can see that buying the Nifty below its 200 DMA has been a good trade. Of course, it can swing much lower than the 200 DMA also, but given that every such swing below the 200 DMA has not lasted for more than a year or year and a half at worst, that gives us confidence that even in the worst of falls, it took less than a couple of years to come back. So and this kind of a rally that we've seen, and the fund flow. So one key key statistics to keep in mind is that $1 trillion of funds have flown into the market globally in the last 12 months, and that is equivalent to the last 18 or 19 years of inflows put together. So this is the kind of money that has come into the markets. Now whether that money will go out or it will churn here, or more will come in, that will basically decide how the markets go from here. So valuations aside, it is basically the flow of funds that is really deciding how the markets are behaving. We can try to justify based on valuations, but we have seen in the last year and a half, those valuation justifications don't really matter. What will matter eventually is the fund flow. If the fund flow has to move out, then no valuation level is able to stop it. If the fund flow is moving in, then no overvaluation is stopping it on the other side as well. So fund flow is basically the main sort of criteria based on which markets are moving, and FIIs have been selling out in the last many months. Retail has still been holding on. It will largely depend upon the next few months how retail will behave, whether they will be able to counterbalance the FII funds, or if FII flows start to trickle back in again. So let's go back to the presentation. So here we've created a table of 10% falls in the Nifty. So 10% fall from the peak. They could have gone much lower, but we are just looking at how much time and how many such falls were there. So in the last 20 years, there have been about 13 occasions. So almost one every 1.5 years, you can say on an average, where the market fell 10% or more. So Feb 2000 to March 2000, Nifty fell 11%. 2004 again 10.5% in this very short period. Then in March April 2005 again 11% fall. Again 2005 another 10% fall. 2006 another 13% fall. 2007 11% fall. Again another 2007 11% fall. 2008 17% fall immediately, but eventually it went down to 65%. November 11 10.5%. 15 10.5%. 2018 10%, another one in 18 12%, and in 2020 initially 11%, and then it went on to about 35%. So 13 occasions in the last 20 years where we had within a month or two a 10% plus kind of fall. And if we were to look at 20% falls, these have been much less, but even these have been about 8 occasions. So the 2000 fall going in about a quarter to about 20%. In 2004 again going to 20%. 2006 21%. 2008 22%, but eventually going much further. This was extremely rapid in about 3 weeks. And 2008 to 2011, a longer one. I think this one is incorrect. It should have gone in 2008 itself, much deeper. 2010-11, this is correct, another 20% fall. And then 15-16 and 2020, the COVID fall here. So on an average, year and a half, 10% falls. Every 2 to 3 years, about a 20% fall. And then we've had 3 occasions when we had more than 30% fall. So 2000 was the dot-com crash, 2008 was the global financial crisis, and 2020 was the COVID crisis. So in 2 decades, we've had 3 occasions of 30% or more falls. So once every maybe 6-7 years, and that has been somewhat the case in the last couple of decades. So, and of course we have 40 and 50% also, 3 or 4 occasions. Again, the same ones went deeper later on. And so the idea that I'm trying to make here is that 10% Nifty falls are par for the course every year and a half. I mean, that's no big deal really. In the current context, Nifty has fallen just about 10%. Small caps and mid caps have fallen about 15%. Bank Nifty has fallen 20%. So this is something that you should be expecting anytime within a year and a half of a run. So this is par for the course. Now, whether this will deepen into a 20, 30, 40% fall, or it'll reverse from here and the market sort of continues upwards, that is anybody's guess, and that we will only be able to analyze retrospectively when it happens. Another key sort of statistic that you can look at is that a large number of days, 20% of the days are spent when the fall is between 10 to 20%, and approximately I would say 40 to 50% days are spent between 0 to 10%. So the market will remain between 0 and 10% for most part of the of its journey, and then 20% of the days will be spent between 10 and 20%, and then of course much lower, 11%, 9%, 5% and 2% at much deeper correction. So the painful periods of the market are much less in terms of number of days, but of course even 5% or 10% is a pain if you see it that way. But deep cuts are there for very shorter number of periods, and especially if you are not doing a one-time lump sum sort of investment, if you're coming in with SIPs, etc., then this will get further diluted by a large amount. I mean, a SIP investor will face much lesser pain than a one-time lump sum investment in case he comes in at or near the top, so on and so forth. So this is another something that we looked at, that in case you started your year on 1st January of any year, if you started investing, then in each year did you witness a 10, 20, 30% fall? So yes, in year 2000 you had a 10% fall, which became a 20%, which became a 30%. 2001, 10 and 20, 2002, 10 and 20, 2003 was only 10, 4 again 10 and 20, 5 again only 10, 6, 10 and 20, 7, 10. So you can see that in every year, starting from January 1, you had a fall of 10% at some point. And 8, 9, 10, 11, 12, 13, 14, only in year 14 you did not have one. Sorry. And the last page is 17, you did not have one. And 20% falls have not been coming last many years. After 2011, we did not have a 20% fall from Jan 1 till for the rest of the year. But 10% falls from the start of the year have been very frequent. And 2021, actually, we are still above the first January of 2021 levels. So the whole, just to bring things together, heavens have not fallen, at least not as of yet. And if your investing strategy, whichever way you are following, whether you are following weekend investing, whether you're doing your own strategy, whether should not really get bothered by a 10% fall in the market, because that is par for the course. I will also show you one chart of Nifty. So this is a Nifty 12-month. Each candle is 12 months, 1 year basically. This is a 30-year chart of Nifty. Now, can you just see how many red candles are there? There are just a handful of red candles. And many of those red candles are just, doji candles. So not much of a change in that year. Only 1, 2, 3, 4, 5, 6 candles out of 30 candles, or more than that actually, 32 maybe, which are of some significant red. Otherwise, the movement has been upward, and upward. Even the current candle of the current year 2021, which is closing in 10 days, is also solidly green, even after today's fall. So must have a long-term perspective, must have the right perspective that short-term falls are par for the course. They will always come. You will not be able to stop them. You have to take advantage of them. And yes, once in a while, all of us will get hit very, very badly, like maybe here, or maybe during this COVID fall, or maybe these 2 years here, 2000. But that's life, right? I mean, as long as you are coming out of it and you are sticking to your strategy and you are able to keep deploying capital, this is the price we pay for getting better returns than keeping the money in the bank. So, given that we want better returns, this is something that we need to accept. And once we accept that, the journey, your journey in the market and your journey in investing will become very, very smooth. So with these words, I'll bring this daily Bytes to a close. Thank you so much for watching. I missed shooting this every day, as well as I got so many requests that, why have you stopped daily Bytes? We just took a small break, and we should be more regular going forward. So thank you so much for watching, and I'll see you in another video. Bye.